I know that I used a big word called extrapolate, but what does it mean? It has a very simple meaning. When I say extrapolate, we'll take an example to understand what it is. In that blood test, say there is a small sample what you are giving to get your blood group tested. A small sample is given, say the outcome is your blood group is O positive. Does it mean that your blood group is O positive only for that sample or for the entire blood in the body? For the entire blood in the body. Meaning, the result which is coming from this sample, you are assuming is the result for the entire blood, or the result what is coming from this small sample, you are concluding that, oh, for the entire blood, that is the result. That process of assuming or concluding on the entire population is what is called as extrapolation. That's all. Now, I'll introduce two other very interesting words to you. One is expected error, then tolerable error. Let us understand what these two words mean. Say, now the time is 9 o'clock. You want to go to a railway station or airport and you want to book a cab. The app on your mobile shows that it will take 10 minutes for the cab to reach you. You booked it. You were expecting that the cab will reach you by 9:10. Now, even when you were expecting that the cab will reach you by 9:10, some little delay you would have been okay with right at the time of booking. Something like, I know that the cab should reach by 9:10, probably due to a little bit of traffic, the cab might reach me at 9:11. So there is some amount of expected error which you would have anyway considered. Now it's 9:12, 9:13, you are not happy, but still you are like, what is this? There is a delay. You are still not calling that cab driver. Now it is 9:13, it's done. You are like, it's already 3 minutes delayed from what the original time was, and now you call up the cab driver and say, where are you? I'm waiting for you. Why are you delayed? Now, in this example, 1 minute over the 10 minutes of scheduled time was considered as expected error. But even beyond that, there was some level up to which you tolerated. The 3 minutes time is what is called as tolerable error. After that was complete, then you said, no, I think I have to call up the cab driver and understand what the problem is. Friends, this is what is this expected error and tolerable error. In a company, if you are doing an audit, how will this concept be relevant? You are doing the calculation of depreciation. You made an expectation. From expectation, you feel that actuals is ideally it should be equal, but maybe there can be a small from expectation. You thought, okay, 1% deviation from expectation is okay, and you made a cutoff in your head. 2% maximum there should be a delay. Beyond that there should not be delay. There should not be deviation from expectation. Actually, the deviation from expectation turned out to be 3%. Will you be happy with that? No, you will not be, right? So this 1% is called as expected error. 2% can be called as tolerable error. We will now talk about sampling risk. To talk more about sampling risk, first we will understand what is the meaning of risk, and then we will bring it to the context of sampling. Risk in simple terms means that our objective is not met. Right. What does it mean? Say you are walking towards a bus stand. What is your objective? You want to take a bus. What is the risk? You may miss the bus. That's all. So the risk is objective not being met. In the context of auditing also, auditor may have an objective. The risk that objective is not met is what is called as auditing risk. Okay. Now, let us bring it to the context of sampling. What is your objective as an auditor with respect to sampling? You want to select a sample which is a representative of population. Okay. Then what is sampling risk? Let us draw the same analogy. What is sampling risk? Risk that the sample so selected may not be a representative of population. See, taking bus is the objective, missing bus is the risk. You want to select a sample which is representative of population. Risk is that you might end up selecting a sample which is not a representative of population. So basically, risk is that deviation from expectation. Okay, what will happen? You actually chose a sample which is not a representative of population. What will happen? Let us see what will happen with that. In our class example where there is teacher, there is student, in this example what we chose, I want to ask the students, is the speed okay? Should I increase the pace? Should I decrease the pace? I want to ask this question. If I ask an intelligent student like you as to if the speed is okay, maybe you will tell me, yeah, speed is fine, no, increase the speed. I think it is slow, you increase the speed. Somebody like you may say that. Based on that, say if I actually increase the speed, what is the risk? I thought that maybe everybody wants me to increase the speed and I just increase the speed. And as a consequence, maybe many people don't understand it. The risk is that your opinion might be an exception. You are so smart, you are so intelligent that you tell me, hey, increase the speed. But this may not be the average caliber of everyone. So then the exception should not be considered when we are talking about this sample selection. So friends, the risk is that the sample so selected may not represent a population is what is called as sampling risk. Let us understand sampling risk in detail. We will take a small example to understand this. Actually, sampling risk is divided into two types. To get a clarity on this, this example will give you a lot of understanding. Now, say there are totally 10,000 invoices in a company, sales invoices in a company. Out of 10,000 sales invoices, there are problems in some 100. Let us say the problems could be because date is not written on that invoice or amount is wrongly written in the invoice, invoices are not signed. Like this, there could be different problems, right? So, say there are about 100 invoices out of entire 10,000 where there are problems. For convenience, I will call them as red invoices. Means there are 100 red invoices in this company and balance 9,900 sales invoices are green invoices. Wonderful. Now, you are an auditor. You cannot select all 10,000 for verification. You selected only 200 of those invoices. Now what you have done is, in type 1, you chose a sample where it so happened that all the 200 units what you chose happened to be green. Now you verified that, you feel that everything is okay because these 200 units there is no problem. All these are green invoices. Based on this you said, in population I think everything must have been okay. But you know very well, out of 10,000, in 100 there is a problem. But here in 200 everything is green. This gives you a sort of comfort that everything is okay when in reality everything is not okay. This is called type 1 risk because here the sample is not a representative of population. Now come to type 2. What is type 2? You chose 200. In this 200 what you chose, there are 50 items which are red, 150 which are green. Now what will happen? You are an auditor, you will say, hey, what is this? Out of 200, 1/4 have a problem. It means there is a big problem in the population what we selected. Wait. In the entire population, actually only 100 out of 10,000 have a problem. But in the sample what you selected, looks like you got more items which are erroneous. So because of this, auditor will feel that, no, I think there is a big problem in the company, invoices are not proper, 1/4, like this, auditor may start having some sort of discomfort. Then what will auditor do? I think I should do more work, there is a big problem in the company. Like this, the auditor may start increasing the amount of testing. But when you know that, no, I don't think really should have done so much of work as an auditor. So friends, these are the two types of risks. In both the cases what happened? In one case, all greens. In one case, 50 red and 150 greens. So here both are not a representative of what the population is. This is called type 1 risk, this is called type 2 risk. We also call them as type 1 error, type 2 error.